I'm Romaine Bostick, and welcome to Bloomberg Triple Take, where we take one key topic and we split it into three unique angles. And today, we're talking about, well, jobs. Fed Chair Jay Powell and other global central banks battling inflation, and we're looking at the economic fallout from their actions, particularly when it comes to the unemployment picture. Now, during the pandemic, we had, of course, the Great Resignation, where we saw workers in the driver's seat, and those quit rates, well, they were soaring. But Taylor, now there's some concern that maybe the tables have turned a little bit.
How short that period lasted, maybe. And I know that we're going to try to get a lot of answers to those questions, not only for the employees, but for the employers as well in the next 30 minutes. Let's kick off sort of our roadmap, Romaine. How much of this is recession risk? We've talked a lot about this being a self-fulfilling prophecy. If we start talking about a recession, will we get one? Does that lead to job layoffs? That will be a topic that we'll go into. Then, of course, the layoffs, do they increase? Where are we in terms of the economic cycle? And then finally, the job postings. We're going to have a great conversation with an Indeed economist, Romaine, about how we think about these job postings. Are they real? And what sectors are really still hot right now? It was interesting. It also comes on a big day when we heard a lot about the recession, a lot about inflation from Fed Chair Jay Powell. Take a listen to what he had to say earlier about the path ahead for the economy.
You're seeing growth slow from the very elevated levels of last year associated with the reopening. You're seeing the beginnings of job growth slowing to more sustainable levels. And, you know, there's risk in that. There's obviously risk in that. Monetary policy is famously a blunt tool, and there's risk that that weaker outcomes are certainly possible, but they're not our intent.
Here to kick off our first take is Michael Pugliese, Wells Fargo economist, joining us right now. And Michael, I do want to kind of start off with this idea of recession risk. And, you know, it doesn't necessarily mean we go into a recession, doesn't necessarily mean it's going to be a prolonged recession. But certainly the risks are elevated right now, even based on what we've heard out of other members of the FOMC here. Do you anticipate that some of those worst case scenarios could come to bear?
Yeah, well, thanks, Romaine. And I absolutely do think that there's a chance that those risks could come to bear. You just heard Chair Powell say it. Monetary policy is a blunt instrument. It acts with a lag. And when you think about what the FOMC is trying to do right now, they're trying to rein in inflation that is well above their 2% target. And so they have risk both ways, right? There's a risk of them not doing enough and allowing this inflation issue to persist longer than they desire. But of course, there's also the risk that they go the other way and they over-tighten, they overreact to the problem. And as a result, they cause the economy to slow a lot more sharply than anticipated. And in fact, it's in our forecast that sometime around the middle of next year, we probably will see a recession in the United States, not a deep one, not a prolonged one, but that we will see growth slow down pretty materially and be sub-zero by the middle part of next year.
And Michael, if we think about sort of the spectrum of outcomes we could have here, I mean, recession, that sounds like that is your expectation for what could happen. A soft landing, though, maybe on the other end of the spectrum. Is that just a distant dream at this point? Is there any possibility that the Fed could pull off a soft landing?
Yeah, I certainly think it could. You know, when I think about some of the challenges that have faced the Federal Reserve over the last 6 to 12 months, they've gotten unlucky in some ways with COVID disruptions that I think were worse than anticipated, starting with the Delta wave and then the Omicron wave over the winter. Certainly the Russia-Ukraine crisis and the commodity price fallout from there, the COVID situation outside the United States in places like China. Those have been forces that have had a negative impact on the economy here in the United States that, if the Fed could get a little more lucky in some of those areas outside of its control over the next 6 to 12 months, that might permit them to say, okay, rates are at neutral at this point. We're going to keep tightening, but not necessarily as much as we previously anticipated, which could help keep this cycle going for a lot longer than plenty of people expect right now.
Michael, this is a little bit of a sensitive question. I'll be careful how I phrase it. We've heard some analysts and economists say that inflation hurts everyone. Everyone is feeling the effects of what inflation at 8.5% feels like. A recession, though, only hits a few people, those who are laid off. So is it right to be thinking about sacrificing a recession in the sake of tackling inflation, or should we not be looking at it that way?
Well, it's a great question. And I think the concern from the Federal Reserve is, if they don't get the inflation under control now, then there could be even worse repercussions down the road if they allow it to linger. Something I think the Federal Reserve believes very deeply is that in order to get maximum employment over the medium to longer run, they need some degree of price stability. And of course, defining that is very tricky. 2% is what the Fed says, and maybe it's a little bit below that, a little bit above that. But I don't think anyone believes it's in the 5 to 8% range where we've been hovering for the past several months, depending on the inflation metric that you're looking at. So, I think it might be a trade-off in the near term, but over the medium to longer run, they want to achieve maximum employment, and that's going to, I think, require some degree of price stability.
And I'm curious, though, do you think, though, the Fed specifically in its efforts, and we're showing on the screen right now some of the central bank moves, including by the Bank of England, and I guess some of the non-moves with regards to the Bank of Japan. And I'm wondering, can we do this? Can the Fed do this, accomplish this, without a little bit more synchronization among some of the other major global banks?
I think they can, but you started to see more central banks move in this direction with tightening a lot, among a lot of developed market central banks. The ECB being a good example. They haven't, increased their policy rate yet, but it appears to be in the offing here over the course of the second half of this year where they'll be tightening monetary policy. So I do expect some degree of global coordinated effort there, and I think the Fed will take the appropriate steps necessary to kind of adopt their own tighter monetary policy through higher rates, through quantitative tightening, as they try to shave off at least the portion of inflation that is contributing, from the excess demand side.
All right, Michael, great stuff. Great to catch up with you. Hope to have you back soon. Michael Pugliese there, Wells Fargo economist, helping kick off today's Triple Take. Now moving on to our second take, a little bit more of a focus on some of the layoffs out there, or at least some of the announcements about potential layoffs. Growth slowing, labor costs increasing companies. A lot of them out there, Compass, to Coinbase, and others, have already announced either firings or hiring freezes. Joining us now to discuss is Bloomberg U.S. economy reporter Reed Pickard. And Reed, we were talking a little bit earlier about your economic reporting colleague, Steve Matthews, who kind of made the case a little bit earlier here on the Bloomberg properties that, when you look at the job market, it is still pretty healthy. And that might actually be more evidence that we're not headed towards a recession. But when you start to get all this commentary out of these companies, I'm curious as to when and if that data starts to show up, whether those comments start to show up in the official economic data.
So if you look at the official data that we have right now, it still shows an extremely tight labor market. You've seen jobless claims, which is filings for unemployment benefits. You've seen those slowly tick up in recent weeks, which is something certainly to keep an eye on. And we'll get new data tomorrow. But ultimately, the picture is that there's not a lot of people getting laid off. So when we start to look from that perspective at who is getting laid off, you start to realize how kind of sector specific it is right now. So when we think about some of the big layoff announcements that have happened, something that comes to mind for me is jobs that are related to the housing sector. And that has been the sector that's been one of the first hit by the Fed increasing interest rates and therefore seeing mortgage rates spike to rates that we haven't seen since 2008. So jobs related to refinancing, jobs related to selling houses more generally when we've seen existing home sales pull back. Those are the types of industries that we're seeing be affected so far.
And we definitely got a reminder of that today with that Bloomberg News exclusive about JP Morgan's layoffs. But Reed, I'm curious, how much of this is a product of overstaffing, perhaps, over the past few years?
And so you start to see that too. So when you look at, for instance, a company like Coinbase, a lot of the people that they laid off, it's a similar number to the amount that they've hired recently. So some of these tech companies, that one in particular is related to crypto, but some of the other companies that have announced layoffs have been companies that have really ramped up hiring in recent years. So it'll be interesting and, to me, start to be concerning when we start to see companies that have maybe been stably hiring, been kind of hiring at a stable rate over the past few years, or haven't seen this kind of huge surge in hiring. If you start to see those companies lay off workers and impose hiring freezes.
How much of this is also within the private sector? I sometimes participate in the Bloomberg Technology Show, and we speak to a lot of investors, venture capital, and they've said, we're telling our portfolio of companies to be prepared to not raise cash for 12 to 18 months and stop hiring because we can't predict what the 12 months looks like.
And I don't think anyone can predict what the 12 months look like. I had a story out today that was about how even if you look at economic indicators, there's several that you can look at, and you can look at them from a glass half full or a glass half empty perspective. And Nick Bunker, who's an economist at Indeed, had this great quote where essentially he said, you know, we're kind of in this ambiguous part and confusing part of the economy right now. And it's hard enough to decode the data right now, but trying to decode what's going to happen down the rest of the year or even next year is extremely difficult. And I think we've seen that a lot in even how much folks' recession forecasts are different, whether they're predicting one in the next 2 years or not, and when they're expecting that recession to occur.
That sets it very nicely for our next segment. Really appreciate it. Our very own Bloomberg's Reed Pickard. And coming up, as she mentioned, of course, in our third take, we're going to get some of the latest insights on what the, quote, great resignation is, how it's going, how things might be turning around now in the other direction. Svenja Gudell, chief economist over at the job search site Indeed, joins us next. This is Bloomberg.
This is Triple Take on Bloomberg, and today we're focused on the economic fallout from a more aggressive monetary policy across the globe. So far, we've discussed Fed Chair Jay Powell and, of course, his challenge of trying to pull off that proverbial softish landing. Plus, we touched on the wave of layoffs that we've seen in recent weeks, some of the announcements, some of the illusions out there by corporate America. And now we're moving on to our third take, Katie, and we're nothing if not data dependent here, and we talk about the potential end of the Great Resignation.
Well, we have some great real-time data from Indeed. You're looking at job postings on Indeed. They're 54% above pre-pandemic levels, but as you can see here, they've started to level off. So maybe that worker shortage that came from the Great Resignation maybe starting to ease a little bit, changing that dynamic, Romaine. Leaves a lot of questions for what that means for the future of the labor market.
All right, let's bring in Svenja Gudell into this conversation, chief economist over at Indeed, which, of course, Reed Pickard was just talking about, the job posting site that has more than 250 million visitors each month. And Svenja, I remember, a few months ago, we were all talking about the quits rate, something, I think, an economic data point that a lot of us didn't even pay attention to prior to the pandemic. And we saw that go up, and it was a sign of, I guess, a healthy job market, or at least one that was tilted in favor of the worker, him or herself. What do we see now with regards to some of those quits rates as we stand today?
Yeah, thanks so much for having me on the show. And that quits rate is a really interesting stat to look at. We're still seeing a historically relatively high quits rate. It's slightly lower than it was at the peak, but overall we're still seeing what we at Indeed like to call the great job hop, if you will. It's not, when you're talking about the Great Resignation, it's incredibly one-sided. We're seeing that people are leaving their job, and that's where the quits rate comes in, but then they're taking on another job, and that's really a signal of the options available to job seekers out there in the labor market right now.
Are those options still available?
Absolutely. I definitely think overall, when you're looking at the job market as a whole, we're in part normalizing, right? It's the kind of thing where it's no longer 110 degrees Fahrenheit out there. We're cooling off, but it's still darn hot overall. And it's in 95-degree weather. It still feels like it's incredibly hot. That's what we're going through in the labor market right now, and we still have a whole lot of options out there for job seekers. And one of the things you can look at to measure that, and you have that stat up there right there, it's 1.9 job postings for every unemployed worker. And so we still have a lot of jobs available for seekers. And the good thing is that those jobs do come with additional benefits, if you will, at this point, as we're still seeing a lot of remote work being offered, or hybrid work, and a lot of job seeker interest in those options.
That's something I've been wondering about, sort of as maybe the balance of power shifts a little bit, maybe workers lose some of their leverage as the job market cools, whether we are going to see those remote work options go away. What does your data tell you?
So far, we haven't seen a distinct cooling off. I think when you're looking at particularly some sectors, when you're digging into software development, for example, we aren't seeing quite as many jobs as we saw at the peak of that measurement of remote work offering that benefit, but it's still incredibly high. So we've lost a few percentage points in terms of how many jobs are giving you that benefit of hybrid work or full-on remote work. But in the grand scheme of things, particularly for industries where it's much easier to work from home, we're still seeing a large fraction of jobs offering that remote work.
I am curious with regards to some of the wage gains that we've seen over the last couple of years, and how that, if at all, could affect the rate of layoffs going forward. The idea that wages are sticky, it's hard to give somebody a raise up to $20 an hour and then tell them 6 months later, we're going to take you back down to $15 an hour. What you're going to do is just push that person out the door and either hire someone at a cheaper salary or not hire anyone at all. Is there a correlation there, an inverse correlation there that maybe we should be on the lookout for?
Well, keep in mind that nominally wages have been rising, but in real terms, we actually have seen fewer people get an increase over the last year here, just because inflation has been so high. So yeah, we're pushing wages up, particularly in the bottom end of the wage distribution, where you're looking at lower income jobs. But in the grand scheme of things, in real terms, so inflation adjusted, oftentimes we're not seeing a distinct increase there.
How big of an issue still is flexibility in that work from home?
I think it still is a really big draw, and I think a lot of firms are currently, trying out different approaches. Obviously, or perhaps not obviously, it's good to know that roughly only a third of the entire workforce has the ability to completely work from home, and so you have that to contend with. But particularly if you're looking at who's entered the workforce again, who's come back, you'll see that for women in particular, flexibility ranks really highly as one of the things that female job seekers look for as they're trying to return to work, as oftentimes they're still dealing with childcare issues at home.
And we've been talking a lot about layoffs over the past few weeks. And like we were talking about in the previous segment, I mean, you've been seeing it in housing-related industries. You're starting to see it in tech as well. I'm curious what you're seeing in the postings on Indeed when it comes to maybe some industries feeling the pinch a little bit more.
Yeah, it's overall you had the graph up in job postings on Indeed are starting to level off in terms of their growth, and that is more pronounced when you dig into different sectors. So looking at, for example, the software development job sector, there we're actually starting to see more pronounced slowdown over the last few weeks now. The last 4 weeks are down 7% in terms of how many jobs are being posted there. And that is actually accelerating. So going forward, we do expect to see more momentum there. And as companies, particularly in tech, are starting to put their hiring on a freeze, we're seeing that in the data.
Really appreciate it. Svenja Gudell, Chief Economist at Indeed. Really appreciate your time and your thoughts. And stick with us, because we'll be back next with our final take. This is Bloomberg.
All right, welcome back to Triple Take. Time now for our final take. A take, of course, on the jobs market. Look, it's still about another week and a half, I think, or so before we get the next big monthly jobs report. But we're seeing so much anecdotal evidence out of these corporations that if they're not laying off people, they're certainly taking a look at their staffing needs right now and maybe making an assessment that they weren't making a few months ago.
Is it just within a housing sector? Is it just within a crypto sector? Is it just within a Coinbase or Robinhood? Or are we going to start to see this more widespread? That is the bigger question.
That's the bigger question. It's the fear, too. And if you think about all the banks that have recession as their base case now, that in the next 18 to 24 months, we're going to finally see that downturn, I think that implies that it's going to broaden out from just those sectors.
And I wonder what's sort of the red flag going to be. I feel like a lot of the announcements that we've gotten is primarily affecting more white-collar workers, a lot of office jobs. But if that starts to trickle down to the manufacturing level and even into the services sector, what message does that send?
And to think we didn't have thoughts for 90 seconds.
Well, we should point out that before we came out of commercial break, they were having an intense discussion about cats.
Cats and balconies, harnesses.
And the yen. I hear it was weaker.
You were talking about cats and the yen?
The pair was lower, but in any case.
That was Triple Take. We're not
spill
crazy.
all the tea on this show.
We promise. Bloomberg Technology is up next. This is Bloomberg.